and welcome. You're watching IPO KYC with me, Reema Tendulkar. You've probably swiped your card on a Pine Labs machine. It is one of the most familiar names in the merchant payment system. And now that fintech is going public, Pine Labs is hitting the market with a 3,900 crore IPO. And here is everything you need to know about the IPO. Joining me now is Mr. B. Amrish Rau, CMD and CEO of the company. Thank you very much, Amrish, for joining in. You've also lowered the fresh issue size, and I'll come back to that in just a bit. Now, Pine Labs swung to profitability in Q1, just before the IPO, after years of losses, and that too, it was triggered by a one-off tax credit. When do you turn profitable on a sustainable basis?
See, in Q1, let's keep the one-off profits away. We still were about 5 crores negative at a PBT level. However, over the last 5 years, and when you look at the specifically over the last 3 years, we have been EBITDA positive consistently. In fact, in FY24, we were at about 160 crores of adjusted EBITDA. Going into FY25, we came in at almost about 355 crores. So we've doubled EBITDA on a year-on-year basis. And in the first quarter that we've obviously published those numbers in the RHP, in the first quarter, we've come in at about 120 crores plus in terms of adjusted EBITDA. So at an adjusted EBITDA level, we've always been good. Now let's look at the line items below the adjusted EBITDA line. There what we have is obviously the ESOPs cost. We've actually taken an industry first move where just recently before the IPO, the ESOPs that we have issued, we've actually issued it not at a deep discount level, because we believe as you go public, you need to look at not just in terms of net revenues, contribution margins, EBITDA, but also need to have a deep focus on the PAT line. So I want to let everybody know that the trend that we have shown on the EBITDA front, we would love to repeat that at a PAT level also.
When do you turn profitable at the PAT level?
At a PAT level, as I said, in the first quarter, we have turned positive. And the trend in general, where we were at a PAT level negative of about 350 crores. Last year, we went to about 140 crores. And now we are at positive. I don't think so the trend is going to reverse. We will want to continue that trend going forward. So Q1 was the first quarter that we are PAT positive. As you know, Q2 is very well done and over. We would love to continue the trend going forward.
Got it. So while India's digital payment volumes is growing leaps and bounds, the monetization is shrinking, especially with zero MDR on UPI. And now even the POS hardware is getting increasingly commoditized. How do you improve your profitability from here on?
That's a great question. But let me just first set the baseline in terms of what we do. In the RHP, what we have identified is we operate in two large business lines. One of the business lines is what we do on the issuing side, where we issue out prepaid cards, wallets, we hold money, all of those services. That's almost close to about 30% of our overall revenues. The remaining 70% is very well diversified between POS-based revenues, revenues that we earn on value-added services where we enable other financial institutions, other fintech to do specific offers, campaigns, installment payments on our terminals. That's another piece out there. And then the third piece to it is largely what we do in terms of online BBPS using the DPI, the digital payments infrastructure of the country. Today, the POS-based revenues in our business has now shrunk to less than 50% of this digital infrastructure
Which
business,
is 70%.
Which is only 70%.
So POS machines, leasing it, maintaining it, you would say is less than 50% of 70%, so
that
about a third of your revenues.
That is correct, right? So where we have it out there. So what we want to do is we want to continue to build the best technology when it comes to checkout. Let me give you one example. Yesterday I was out, in Parel in all of the malls, and you went to Zara. And there, if you see, the checkout has completely changed. You can throw goods into a box out there and you can just simply check out there. In many of these cases, there is a Pine Labs terminal. We see ourselves as a technology provider when it comes to technology. Technology does make revenues, and that's the way we've actually built our business. The other piece to it is went and bought a TV. Now that TV was bought on the installment payment services, where we bring thousands and thousands of consumers. We bring in about 30 credit institutions. We bring in about 300 brands to convert transactions to installment payments. We make money out there. And then finally, we are now processing huge number of volumes, almost billions of dollars on a monthly basis when it comes to bill payment transactions, online payments transaction. There again, we are able to make money. So as far as our business is concerned, we see ourselves as a technology company and we make money there. I want to go and add something. When you look at the word fintech, there are two parts to it, fin and tech.
Tech.
We are the tech of fintech.
Got that. So what will be sustainable margins for you? We've seen your margins improve from sub 10% in FY24 to nearly 20% in Q1. What is the sustainable rate you are gunning for?
See, one thing what we wanted to do is we wanted to demonstrate that there is an ability for us to expand our EBITDA while we continue to grow the business. Over the last 3 years, we've been safely 20% plus when it comes to revenue growth. But what we've also wanted to do is we wanted to show an EBITDA expansion in our business. We've shown an EBITDA expansion where EBITDA has gone from low single digits to now at 20% in Q1 of this year. We want to continue to showcase that this is a company which has been built on two pillars. One is consistent growth and also consistent improvement in EBITDA, obviously positive EBITDA. And that's what we've actually been able to do in Q1. But the way I look at it is this is just a starting point. It's a trend that we want to continue to work on.
So global peers that you compare yourself to, whether it's in Southeast Asia, what margins do they operate at?
So we have seen internationally there are companies in the payment space which are operated anywhere from 40 basis points, 40% of EBITDA to almost about 55% of EBITDA. But that's happening in global markets. One of the things I should point out is 15% of our revenues today now comes out of international markets. See, look, the government of India constantly talks about the fact that what we have developed in the fintech space in India can be exported. We are one of the first companies which are actually taking fintech products out of India to international markets. Today, if you go to a banker or a retailer, may that be in UAE or Philippines or Singapore or Malaysia, where we have customers, they actually believe us. They believe fintech coming out of India is world class and can handle the scale at which they want to run their businesses. And we've got great clients now in these 5-7 countries. We are currently present in about 20 countries globally with our fintech stack.
And international is 15% of your revenues. That is growing faster than India. And what is the balance that you're looking at in terms of a revenue mix?
Absolutely. So international for us is now at 15%. International business has been growing at about 80% on a year-on-year basis. We believe our product stack, which we have developed here in India, is absolutely relevant in global markets. The other thing is, in India, fintech is so very well evolved, and the various workflows and the IPs that we've been able to build, they're all new for some of these emerging markets like Southeast Asia or Middle East or even Africa. And we've got, as I said, clients now in about 20 countries. We do want to continue to invest into global markets. As you would expect, the global markets EBITDA profile is different than the EBITDA profile here in India.
Higher?
It is obviously higher. As I told you, international markets, it is in higher EBITDA profile. So we are investing heavily there. We started about 3 years back. In fact, a certain amount of our proceeds out of this IPO is towards international expansion.
Your operating cash flows is still negative. I mean, what's causing the drag? And how will you improve your cash conversion as you scale up?
See, one of the things I should clarify out here is in a payments company, there are always some mismatches around settlement. The operating cash flow, when it turns negative, it's purely in terms of some of the settlement related activities that we are doing. But if you look at it from an EBITDA standpoint, we actually came in and adjusted EBITDA of about 355 crores last year. So purely in terms of cash generation, I think we are in a good place.
Now, you've used acquisitions to move up the value chain. From being a pure hardware company, you're now providing value-added services on the software side, expand internationally as well. Now, you've earmarked part of your proceeds for acquisition. I mean, is there an acquisition right now on the table that you are evaluating? How soon might you close one? And what would be the driver?
I want to start by saying this, that our stated objective is that we want to build a world-class fintech coming out of India. I think India has a story to tell when it comes to fintech, and that's what we want to do. Obviously, what we are going to find is they're going to find gaps in our product portfolio, which we would want to go in and fill in those gaps.
What are those white spaces?
So, for example, what we've done till now is, as I said, on the prepaid side, on the issuing processing side, we had a gap. We made an acquisition in 2019. We acquired a company called Quicksilver. On the DPI side, on the digital payments infrastructure, APIs are going to be extremely important. We wanted to hire and bring on board a world-class engineering team. We made an acquisition of a company called Setu on that side. And then we also acquired a company called Mosambhi, which powers a lot of the software for some of the top 3 banks in India. Now, those were areas where we had a gap in our product portfolio. We went ahead and made those acquisitions. We've actually grown those acquisitions over the last 3 to 5 years period. So just as a company, we've been able to show that making acquisitions, improving your product portfolio, consolidating them and growing them, we've been very good at it. In our IPO proceeds use, we've identified that we will make some acquisitions. But I want to point this out. We will make acquisitions so that our product portfolio improves. We will not make acquisitions just because we want to get scale in a certain side of the business.
Now, you're raising about 2,080 crore, Amrish. This is lower than what you had earmarked earlier in terms of a fresh issue. Are you deferring some of your growth investments to next year? And with the growth capital that you do get, you were growing at 20% comfortably on it, in terms of a top line. What will the number scale up to with the increased growth capital?
I'll make 2 comments to start with. First is I have more than 1,000 crores of cash on our balance sheet today. That's point number 1. Point number 2 is when we have reduced the OFS and the sale amount, fresh issuance, when we have reduced it, zero has been taken away from any growth related activities. So growth related activities, when it comes to international expansion, technology investment, we made no changes. Just as our financial position has improved, what we have actually done is we have reduced some of the debt repayment activities that we had identified. So when it comes to P&L and growth in our business, we made no changes out there.
Okay. And 20% plus revenue growth, does that continue or do you think you can do better now?
See, look, as SEBI does not allow me to talk about the future, I can only tell you about the past. In the past, over the last 3 years, we've grown at almost about 20%. That's something that we want to continue to demonstrate. That is continued growth in our revenue, in the top line, and the improvement on the EBITDA side, which, as I told you, we've also reached about 20% as far as the EBITDA number is concerned.
Now, competition in merchants payment space is, fierce, from Paytm to PhonePe to Razorpay. Now, PhonePe, for example, has also launched its own POS devices, and it is increasingly aggressively expanding into the offline merchants payments, which has been dominated by you. How do you protect your share and pricing power?
In the last 3 years, the volume, the GTV growth in our business has been more than 60%. The number of transactions on our platforms have compounded at more than 50%. The number of merchants which have come on board have compounded at 30% plus in those last 3-year period. I have no dearth of opportunity. The top 5 bank uses me. The top 3 e-commerce companies use us for our online payment services. We have the top 3 Q-commerce companies all using Pine Labs. So our revenue base is extremely broad-based. Growth is absolutely in place. Competition is not something which keeps me awake in the night.
Okay. Amrish, great chatting with you. Thank you very much for joining in. Thank you.
Thank you very much.